I'm pleased to have, I think we'll have a sufficient number of attendees. We can conduct business this morning. We have just two presentations. One of the potential firms has dropped out for a variety of reasons, including their staffing situation as well as maybe even their workload. So we'll just have two presentations, which will give us a little extra time for discussion and questions if we feel that that's important for us. The two firms have been advised that they have essentially 30 minutes, about 20 minutes of presentation about their history, their capabilities, and possibly why that we should select them to be our firm to represent us in validation of contract activities. But if we have questions to extend beyond maybe 10 minutes, we can do that, and we'll advise the firms as they arrive to make the presentation. With those brief comments, I'd like to call the meeting to order. And Eric, if you could have the opening statement, please.
Of course. This is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you're speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, would you please call the roll?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Mr. Fulkerson?
Here.
Mr. O'Mara?
Here.
And Mr. McGraw?
Here.
Thank you.
Thank you, Sherry. And Sherry, I understand we do not have any public comments. Is that correct?
That is correct.
Good, thank you. And Steve, if you would just provide us with a review of the process we've been through. We've been involved with this for several months. We've let the concept, the idea of looking at compliance of listing contracts that are out with the various fund managers. So Steve, could you just review for us the process, what the staff has done to do the analysis of the capabilities of these firms and any other suggestions or opinions and advisory suggestions that you might have that would be appreciated, Steve.
Sure. Thank you, Dr. Hackbart. So just kind of briefly as a background, as we know, we had discussions with the Finance Committee, the Investment Committee, and the board last year, as well as some presentations regarding potentially contracting with an external service provider, really to independently perform a number of review, validation, and benchmarking services with the ultimate goal of increasing transparency, ensuring effective governance, and reviewing the cost efficiency of the portfolios, especially from a fee and expense perspective. As directed by the CRS Board of Trustees at their board meeting on June 9th, 2025, the KPPA Office of Investments worked with the CRS CEO to develop and issue this RFP for investment cost efficiency services. The scope of services covered in the RFP was to evaluate current investment and investment-related contracts in the areas of risk, cost, and process efficiency, as well as contract compliance. There were three specific areas in the scope of service that were outlined in the RFP: benchmarking and comparative analysis of the cost metrics of the systems, including investment management fees and expenses across the full range of CERS's asset classes and cross-asset services, validation of previously paid fees and expenses for KPPA's externally managed public and private portfolios, verifying that each fund manager correctly billed management fees and expenses as set forth in the signed fund documents, as may have been amended from time to time, and finally, review of external investment manager and investment-related legal documents for contract compliance and non-market standard or non-competitive terms. The RFP was posted to the KPPA website and provided to industry groups and financial media on July 9th. And KPPA investment staff also notified vendors and provided a link to the posted RFP. The RFP closed on August 11th with responses received from 6 firms. Those firms were Alborn, Bellwether, B Finance, BlackRock, CEM Benchmarking, and XTP Implementation Services. Following consultation with CERS leadership was determined to initially focus on the second area of the scope of services, which is the validation of previously paid fees and expenses for KPPA's externally managed public and private portfolios, with the expectation that the other scopes of services would be followed up shortly thereafter. And based on the established criteria, KPPA investment staff narrowed the potential candidates to the finalist candidate pool that's included in the memo. Following the analysis, KPPA investment staff determined that the top 3 candidates were Alborn, B Finance, and XTP. We did believe that each of these candidates met the established screening and diligence criteria and have demonstrated the qualifications and capacity to successfully perform the validation of fees and expenses services as outlined in this RFP. As Dr. Hackbart mentioned, unfortunately, yesterday we received notice that due to changes to their team, since the submission of their RFP response, that they felt that they would impact the delivery structure outlined in their submission. B Finance is withdrawn from the RFP. So with that, I'll turn it back over to Ed.
Just one question, Steve.
Sure.
Conversations are in the information provided to the potential contractors. Whether
Excuse me?
of the number of contracts that they might review, or is it sort of open-ended to be considered between possibly our staff and the contractor in terms of which contracts might be reviewed, or how many of these contracts might be reviewed over the next 2 years or something of that nature? Do we have guidance of that, or is this going to be?
Yep, the scope of services and the RFP provided that all public and private mandates, so we provided a number for each asset class category, and each of the proposals considered. So for private markets, you need, in order to do fees and expenses, you essentially have to do since inception for a number of reasons. For public markets, the consideration was we would go back 3 years and look at 3 years of fees, recalculate and verify 3 years of fees. So it was across all asset classes. Obviously, given the proposals are general in structure, that could be negotiated at the time that we negotiated the contract with one of the service providers. If we wanted to specify only a certain number of mandates or only a certain number of managers.
Any members
Steve,
of the committee have?
do you know the number of managers in each of those 2 categories?
The numbers were included in the RFP. So public markets, we have about 20 managers. And relationships, I think it was just under 100, and that includes every private equity, 125-ish number of managers.
Thank you.
Any other questions on the process we've gone through from any of the committee members? If not, is there anything you'd like to add, Ed?
No, sir. Thank you.
Given that introduction and brief history of where we arrived at today's activities, I guess we're ready for the first potential contractor, XTP, if they could come forward and join us in the, or are they going to be remotely?
Okay. I will let them into the meeting.
Okay.
Give them one more second to join here. So you're muted.
Good morning.
Good morning.
Glad that you can join us. Our committee is very interested and excited about hearing about your presentation. I think possibly Steve has already indicated in terms of the general format of our conversation this morning. We would ask you to maybe spend about 20 minutes talking about your capabilities, your history, some of the experiences that you've had relevant to this potential contract, and any other information you think would be valuable to us as we make our recommendation to the full C board going forward. After the presentation, and that's a kind of a flexible number, but maybe about 10 minutes or a little bit more, depending upon the amount of questions that arise to respond to from our committee members. That would be a general guideline, although We have time this morning, so if it extends beyond 30 minutes, that's not a problem. So with those comments, please proceed. Thank you.
Well, thank you very much. It's a pleasure to be with you. We appreciate the invitation. Sherry, real quick, Nikolai Dordrichter is trying to get in from Germany, but I think there's some restrictions on the Zoom. He's having a hard time getting in from outside the U.S. I don't know if there's a setting that can be changed.
Let me check. I'm not for sure.
Okay, or we could proceed, but just FYI, Nikolai, who runs our private markets team, was hoping to join as well, but we can proceed accordingly. So again, thank you very much for having us in. We're really excited to be discussing this with you again. As reflecting on our conversations over the last year or so, and what we've tried to convey is that we could be, I think, a very impactful partner in improving efficiencies, improving governance initiatives. We're a really unique firm. We don't believe that anybody is doing exactly what we're doing. And if we could just get to the third slide, please. Is it pop? Oh, there we go. Just the next slide, please, if you don't mind. Thank you. So, as we've tried to convey, we're an interesting firm in that we focus on the mechanics, the implementation of your investment decision. So much resources and time goes into steering this big ship in these turbulent markets, and that there isn't much bandwidth left for the how. How are these investments being implemented, and is there alpha being left on the table by inefficiencies? So this is our only focus. It's our only line of business. We've been doing it for 20 years. We've measured over 10,000 portfolios, over $1 billion in savings for our clients. Our clients are only institutional asset owners, and we don't select managers. We don't work with managers where there's no conflict of interest. Our interests are always aligned with that of the investor. If we could get to the next page, please. So we really believe that we are the only firm doing what we're doing. When you think about costs and fees, it's easy to reduce it to an exercise in fee verification or fee validation or trade cost analysis. What we're doing is we're looking at all the costs and leakage that are coming out of your net returns, what we consider the total cost of ownership. So we identify all these costs and benchmark them, and then work with your managers and custody bank service providers to find paths to improve those efficiencies. So there are other firms in the space that will do fee verification. They'll do trade cost analysis. These are integral elements of our service, but it's a much more expansive puzzle that we're putting together. And I can speak, from a unique perspective. I came from a firm, Abel Noser, that was a trade cost analysis provider, and we would provide our reports, and we'd report on the commissions and execution costs. And what we'd find is that the results never really changed quarter in and quarter out. So what drew me to XTP was this impact, right? They're taking the data and making it and yielding savings from it. So the pushback we would always get at Able was, well, this is good to know, but what do I do with this data, right? So if you're looking for a check the box solution, that's not what XTP is. What we're trying to do is proactively find places where we can improve efficiencies from their top line fee all the way down to the mechanics of how transactions are being conducted, how the service marries with your custody bank and those charges. So it's a holistic look at all the costs that are coming out of your net returns that are otherwise not visible to the investor. Not necessarily anything nefarious, right? I mean, these are issues that your managers often don't have the bandwidth to focus on as well. So very often they're excited to become more efficient as well. It's a collaborative effort. It's not combative. And what we find is that, in our 20 years of doing this, there's just a lot of fat on the bone. And if we can add to your alpha, make sure that you're capturing all of the alpha associated with your investment decisions, it makes everybody more efficient. And, we're only compensated when we're able to move the needle. So if we don't find anything, we don't get paid. So it's the entire firm has been sustained for 20 years on this success-based model. Any questions so far? We certainly want this to be a dialogue.
And the assessments that you carry out, do you look backward principally, and did this firm, you basically kind of negotiate with the firm in case there would be some compensation from previous activities and compliance issues and so forth? And how do you approach that?
That's a great question. So if we get to the next slide. Yeah, actually that slide, this one, perfect. Thank you. So this illustrates really our process. So the way it works is we get you would engage your managers to work with XTP. We would get the data directly from the managers. What's the cost above the line here? What's easily accessed by the client. That's typically your top line fee. So we quantify all the costs below the surface. So your trading costs, custody fees, your manager's capacity. We do it on a look back, typically a 12-month look back. We benchmark all of those costs. We're able to find savings below the line, so improve some of the processes that happen below the line with your whether it be transactions or whether it be at the custody bank. And then when you know the total cost of ownership, when you have this complete holistic picture, what it does is it recontextualizes the top line. So now instead of just benchmarking your top line fee, you have this total cost of ownership. What is it really costing you to be invested in this mandate? And what we find is that there are mechanisms to find savings, renegotiate those top line fees as well. Does that make sense?
Certainly.
So we find savings below the line and above the line. So it's fundamentally not just fee verification, right? This is not it's a very important part of what we do, but what we're doing is trying to look at the complete picture, all the costs and fees that are being incurred on your behalf that are otherwise not visible, or the people don't have the bandwidth or data to quantify, benchmark them, and then find places where we can improve.
Okay, Ian, just quick, just so I'm clear. I hear you telling me that there's two components to your savings component. A, where you find where, for whatever reason, agreements haven't been followed to the letter, things of that nature. But through your benchmarking, what you're telling me is sorry. Through your benchmarking, what you're telling me is that you're going back and saying to whatever manager you happen to be dealing with, we see that your custodial fees or whatever fees are running higher than the benchmark, and then renegotiating those down from there. Is that, in essence, what I'm hearing?
Yes. So if we could just go to the previous slide. What we do is we look at the full investment landscape, right? And we're marrying data points pulling data from different places for this complete holistic look. So when you look at all of these costs across your public market portfolios, your private market portfolios, your custody bank, and you factor in all of these components, and then think of things holistically, there are levers you can pull, right, that can yield better commercials, right? So it's not okay, well, we found your commissions are too high. We can optimize those commissions. We can tell you that your commissions are high, but what we more than likely, you're not going to change a manager's trading profile. But factoring that into their top line management fee, you may say, well, look, this is our total cost of ownership. Maybe it's time for a new tier, right? Maybe maybe that's a lever we can pull. So we're able to find places mechanically on their trading, their implementation. Um, we find mistakes in invoicing, we find errors, we find leakage. But also it's a collaborative effort that we're able to take on, and your partners, your managers, want to be good partners as well. And what we find is that when they have the data and they have this kind of new way of looking at it, recontextualized data, it yields productive conversation.
And I hate to pepper you with questions. I know you want to get through your presentation, but of I forget what number it was I saw in your slide deck, something like $1 billion worth of savings you all have uncovered. How much of that, what percentage of that would you attribute to things you found from in the past, and how much of it do you anticipate or future savings?
That's a great question. Yeah, it depends on the portfolio. The lowest hanging fruit we find is errors in invoicing, fee scales that were misapplied. It's hard to pinpoint, but very often on the public market side, there is much more of a go forward basis. We're able to improve efficiencies. On the private market side, it's more of the fees that you were charged were not what you would expect to have been charged in the language of the LPA. So on the private side, it's more of a clawback. On the public side, it can be more of a proactive collaboration and moving forward.
Okay, thank you.
Maybe following up on that question, in terms of issues that you find and suggestions that you come forward with to reduce costs going forward, do you expect to share in forward savings or in clawback savings that might have occurred about how they've approached issues and managed issues in the past?
So if our work yields savings, whether it be a new fee or savings moving forward, we would share in that savings for a period of 24 months. And then the entire savings goes to KPPA, or to CERS rather.
Noticed in your proposal it says verified savings. You want to address that verification process?
Yeah, absolutely. So we want to be a partner. We invoice before we invoice anything. We show you what the work that went into it, the calculation. It goes to you for approval, and then we'll invoice. So we don't get paid unless there is measurable savings that's quantifiable and that's already in your account, right? So there's no strings attached. There's no retainers. We take all the risk up front, but we're that confident that we can find places of efficiencies where that will yield savings.
I took from that you don't get paid until there's savings in our account, meaning until those future savings are realized, that's when you get paid once they're realized, correct?
Right. So if say we are able to negotiate a new management fee, we would not invoice you until the new fee is in effect.
Okay.
And we would send you the calculations, the spreadsheet. Everything is transparent, for your approval, and then invoice.
Okay.
So if we don't find anything, we do not get paid, and that the risk is entirely on XTP.
Okay. And just so I'm talking the same language, I think you indicated that you all have done 10,000 audits, reviews. I don't know what term your projects over your 20 years, is that
We've measured over 10,000 portfolios
Okay.
for about 1,000 managers. So
Okay.
yeah, it's yes. Bill, I see.
Yes, I just so trying to get my arms around how this all works. I guess I'm going to ask, what is your rainmaker? Where do you find the most savings? Is it above the line in calculations, or is it below the line in renegotiated agreements?
It's both. The above the line renegotiation is the. Oh, it looks like Nikolai is in the waiting room. By the way, um, the fee
I'm
can
sorry,
be
would it be under the name Robin Nichols? Because I
no,
do have someone on the phone
no, it wouldn't be.
with that name. I don't know who that person is, so
Okay, I don't think it would be Robin Nichols.
okay.
Um, I'm sorry, Bill. Back to your question. The top line fee is often the easiest way to move forward. If you think about a manager's trading costs, it's driven by their capacity constraints. Oftentimes, it's driven by they're taking multiple days to implement their ideas for all of their clients. There's a cost associated with that, and you're not going to be able to change their footprint necessarily in the marketplace. But by identifying that cost that is coming out of your end, uh, it factors into that top line fee. So it's oftentimes the easiest lever to pull. But very oftentimes there are efficiencies on the trading side, introducing new counterparties, the FX trade, if it's a global trade, how the FX is being handled, if it's going standing order instructions through the bank, or if the manager is negotiating. So we have things that we can improve upon. A lot of times if you have commingled vehicles, the custody rates that the manager has negotiated are stale, and they're happy to hear that. They want to become more efficient on that front as well. So it takes this. It's such a granular process. You never really know where the findings are going to be until you start digging into the data. But you just want to stress that it's a holistic look, right? There isn't one. We don't go down the line and say that's too high. Let's change that. Let's look at things all together and quantify where we think we can move the needle.
In terms of going forward, if you identify an issue or process change that could be implemented, and that might involve contractual adjustments, the manager would have to be supportive of that change in the contract, right? Or in order to achieve that, and therefore I assume that the manager would have some benefit realized as a result of the contractual change as well. Does this get fairly complicated in terms of negotiation about exactly what the terms might be and who would realize the benefit of that change? Or is
Well, we operate under NDA, right? We enter into NDAs with your managers as well. But yeah, I mean, we don't just dump the data in your lap, right? This is a full service extension of your staff. We would, with your approval, so we'd bring the results to you, and we'd say, here's what we found, and here's what we think we can optimize. And with your approval, let's talk to the manager. So then we would talk to the manager, walk through the data, provide suggestions on where we can improve. And if they agree, it could lead to an amended contract, or it could lead to them changing some processes. But yeah, I mean, the manager is a very big part of this. We have to, we talk to them directly, negotiate with them, and collaborate with them, particularly on the public market side, which I understand it seems like the focus today, or the recommendations, it seems were really kind of focused on the private side. The public market managers are very, very open to getting more efficient, and they're open to these data requests. They're open to these conversations. So I would encourage you to think about the whole portfolio, and where we can touch every part of the value chain. Does that make sense? Does that?
I guess the question that some of us have talked about, what would be the potential impact upon our staff? I assume that there would be some involvement in our staff, particularly going forward, for example, contract modifications and so forth. What's been your experience in terms of the staff time that your firm, the parties that you've worked with, is this pretty much handled by your firm, or would there be an expectation that our staff would be involved to some extent as well? I assume that would be the case, but could you talk a little bit about that?
Yeah, absolutely. So we want to be a full service extension of your staff. These are you don't want your staff spending time, their resources, bandwidth on the margins here. We're talking about the margins here, right? So your staff can be as involved or not involved as they want. It's complementary of their oversight efforts. These are areas that natural bandwidth constraints keep even the most prudent fiduciary from. So you send, once the engagement letter is sent to the managers, the service provider, saying you've engaged XTP for an efficiency study, we pick up the ball. We collect the data directly from the managers. We come back to you with our findings, and then in conjunction with your staff, would go and work with those managers to improve efficiency. So we're trying to ease the burden on staff, and complement their efforts in areas that free them up to focus on the big picture strategic decisions.
I guess our questions have intervened with your presentation, so please proceed with your presentation. Apologize for that.
No, I'd rather it be conversational. So if there are questions, please don't hesitate.
Yeah, since you're in the mood to answer questions, let's say you're last to 5, 10 to new clients. What's your average savings for those clients? Do you have a number?
Yeah, I don't want to sound evasive, but it really varies. And the moving pieces are, your allocation, what we're looking at, what their fee scales are, but also, candidly, not every client wants to pursue every optimization, right? So we may find things that we think are compelling. We bring them to you, and the client says, well, yeah, that is interesting, but we don't want to shake the tree with that manager. They're not going to cover off the ball. We don't want to disrupt anything. That's the investor's prerogative, right? So, and that's fine. You're always in the driver's seat. We bring our recommendations to you, and that's your prerogative. Generally speaking, though, we're talking about between 3, 4, or 5 basis points of savings is what we would expect, broadly speaking.
So generally, not too many firms enjoy giving money back. So how does that recouping those funds go? What's the process for that usually?
So one, everybody wants to be a good partner, right? And what we're doing here is we're showing in a quantitative way what your total cost of ownership is, right? So we're not just verifying your fees or benchmarking your fees. What is the total cost to CERS being invested with this manager? So what is the impact of their turnover? What's the impact of their capacity constraints? How are they handling an FX trades? How are all of these things that may seem ancillary are all coming out of the net returns. So when you present this data to them, very oftentimes uh, they're 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 surprised to see the results, and they're grateful for the results. We've had a number of managers in the past few months, big managers that you would know, that you say, well, we never really thought of that. We never thought of handling FX in this way. So, I mean, they tweaked their process, and it's reduced their transaction cost by 80% that in that particular case. So, I mean, they want to become more efficient. And again, it's not necessarily anything nefarious, right? It's just bandwidth keeps it's the implementation efficiency is something that is not generally focused on by the investor or their managers. So if you can improve their efficiencies, they're happy to do so. And if the data shows that their fee is not as competitive as you originally thought, yeah, no, they're nobody's happy to reduce their fee, but they're happy to be your manager, and you're an important client to those managers. And when you bring something that's quantitative, it's not just shaking a tree. You're looking at data here. We're looking at paid prices, over 10,000 portfolios that we've measured. It's a compelling way to look at things. So particularly on the public market side, they're very open to the data and becoming more efficient.
I assume
Thank you.
it's much easier to negotiate going forward versus clawback. What percent of your savings that you basically found were going forward adjustments to contracts versus any clawbacks from previous actions or accommodations or compliance that you have identified in your reviews?
If we could go to the what slide is it? The next. Yeah, keep going. One more. One more after this. Sorry. Yeah. So these are generally our findings. Excuse me. Mistakes in calculations is the lowest hanging fruit. The non-market compliant processes and benchmarking, that there are some of the trading costs that we discussed, and unfavorable contract terms. It's hard to say, where it really depends on what the portfolio is. Usually we find, for a fund of your size, we would find some mistakes in invoicing. I would think the most impactful savings would be on the transaction costs and fee savings, though, moving forward. And on the private market side, I should say it's a much more of an issue. It's exercise in governance, contract governance, and oversight. So on the private side, it's almost always clawbacks. The fees that were charged were not what you would have expected to have been based on the language in the LPA. So the fee base was calculated. Well, the language in the LPA is opaque by design, right? And we find that the way that it's interpreted is generally speaking not in favor of the investor, in favor of the LP. So how that language is interpreted, often yields very big differences in what you'd expect in the fee base, offsets not being taken into account. So on the private side, it's much more of an exercise in governance and clawbacks.
And quick question, two questions. If I understood the way you framed an answer earlier with regard to you come back and you give a presentation on these are the areas or these are the managers that we anticipate being able to get savings out of. And for whatever reason, we decide we don't want to shake the tree with one of them. Am I correct in your earlier answer? Then whatever those projected savings would not go into the kitty as to what we would have to pay you all because we chose not to pursue it. Is that correct?
That's correct. That's
Okay.
correct. Yeah. If you decide not to if you don't want to pursue any optimization potential, that's entirely up to you. Candidly, we're looking for partners that are not afraid of scrutiny, that are not afraid of transparency, and that, that will want to have conversations with your providers to improve processes. But it's entirely our clients' call. They're always in the driver's seat.
Okay. And then the answer to I think Tommy's question with regard to savings, you indicated you would expect somewhere within 3 to 5 basis points typically.
Generally speaking, yeah. And again, there are some caveats, right? But yes,
I understand that.
But the entire firm is sustained on a success-based model for 20 years. There's over 50 people that work just on optimizing costs. So yeah, we believe that we would be an impactful partner.
Okay, so if that's the case, somebody check my math, that would translate into roughly 3 million in savings per $1 billion reviewed.
Well, it depends what we're looking at, right? I mean, if you're basing it on the entire portfolio, we probably would focus. But yeah, I mean that is the math. But it would be, kind of a tiered approach, right? We generally would start with your liquid markets and your custody bank, and then your top line, your most impactful private market relationships. It's not a flip the switch, exercise. It takes time to gather data, and and come back to you with the data, then the negotiation. So it takes some time, but yes, I mean we believe that it would be an impactful partnership.
Okay.
I assume you have some type of reporting process that you typically do with your clients. In other words, would you have like a quarterly report in terms of the number of managers you're working with, your initial results, and so forth? Do you have a process of that nature to keep your clients up to date on what you're doing and your work experiences as well as what you're finding? Because it seems to me one of the potential benefits of this process is we might make adjustments in future contracts if you're finding sort of common issues of compliance and so forth. So that's additional information you might be providing us with. Would you do that sort of on a quarterly basis or annual basis, or what's been your experience in that regard?
Yeah, absolutely. So our approach is project based, right? So we're not giving you a quarterly report. We if there is a finding that we're optimizing, we monitor that for 24 months to make sure that the implementation was done accordingly. So we'll report on that on a quarterly basis. But the initial project is it's we go we look a year back, we come back to you with the results. We keep you we provide an action plan. Here's what we found, here's what we think are next steps. We work with you and the staff and coordinating those meetings with managers and toward the optimization. And then, again, once once the optimization is in place, we monitor that and report on that for 24 months. So, as far as touch points along the way, the staff can be as involved or not involved as they want. But we strive to be an extension of a full service extension of your staff.
Right. We've been involved in this session for about 35 minutes, so if we can resolve another 5 minutes, questions or other comments that you would like to provide us with, or insights you'd like to provide us with regarding your process or your strengths of your company and so forth that we might consider in making our recommendation.
Yeah, I would just like to leave you with, it's a really expansive, granular puzzle that we're putting together. It covers the entire value chain, your public market portfolios, your private market portfolios, separate accounts, commingled vehicles, your custody bank. We don't believe that anybody is doing this the way we're doing it. It's a really robust complement to your oversight efforts. And we believe we'd be a really strong partner. And we don't have conflicts of interest with, managers. It's we don't select managers. We don't work for managers. We're only aligned with institutional investors. And I believe that we would be a very, very strong strategic partner.
Any other final questions? If not, thank you.
I appreciate that final comment because that was probably where my next question was going to go. But I think I've seen this in a couple of pieces of your presentation. 100% of your all's revenue comes strictly from doing this type of work, correct?
Correct.
Okay.
Yeah, there are no other lines of business for XCP. This is our sole focus. It has been for 20 years. And what drew me to XTP, again, from Abel Noser, so I won't bore you with my history, but there's value in knowing in trade cost analysis and fee verification. But what drew me to XTP, again, was how they make this data proactive and actionable and yielding results in a way that I have not seen.
Okay.
So one last question on payment. You said that it was after it was verifiable and implemented. So if we had something that was going forward for 24 months, once that contract is in place, do we owe you the 24-month payment at that time, or do we pay you quarterly, or how is that? How are those funds paid out?
So it would be, so if say we negotiate a new management fee, we would participate in the success as you're paying that management fee. So we would send an invoice quarterly for the difference between the old management fee and the new fee as you're paying it. So that would be the savings that for 24 months. It wouldn't be a lump sum payment.
Okay, and last question. I'm not clear as to how long this relationship averages to be. Do you usually do a work within a 12-month period, or is it an ongoing 5-year engagement? What's the anticipated time frame for your engagement?
That's a great question. What we find is that the more work we do for our clients, the more work they want us to do. If you have new managers that are being brought on, we'll look at the new managers, but the most of the work and the impact will be in the beginning phase, right? But our clients, go on are active for many years. But the biggest impact is early on. It's a project based. So, we look at your portfolio as it stands now and see where we can find savings. And then as it changes in the future, will always be a resource that you'll be able to draw upon.
Any final questions? Well, thank you so much for your presentation and your response to a variety of questions. We appreciate that. It's been very informative, and so thank you very much. And I guess in a sense, you're excused. We will be considering the firms that have applied to represent us in this endeavor. And that will be the next step going forward. We'll recommend one of the firms to the full committee, CERS committee. So thank you so much again, and we appreciate you being here this morning.
Well, thank you very much. It's an honor to be here, and I hope we get to collaborate. Thank you very much, though.
Okay. See y'all?
Yes.
Okay. Well, good. We now have the presentation by Auburn, and we can move right to that. So if we could ask the Auburn representatives to come forward. And Sherry, could you do that, please?
Yes, I'm letting them in as we speak. Good morning.
Good morning.
I just wanted to check your mic for you. Thank you.
Mike is good.
Okay.
Okay.
Am I coming through clear?
Yes, you are. Thank you. Dr. Hackbart, you can proceed.
Good morning and welcome to our meeting this morning. We appreciate you taking the opportunity to join us, to provide us with a presentation of your company's capabilities, your experiences, and maybe some of the factors that we should consider in making our recommendation to the full CERS committee regarding the firm that we would like to go with to deal with issues of benchmarking, compliance, as well as other issues relatable to that. So basically the sort of format we'll be using this morning is we'd ask you to maybe begin with a presentation, maybe about 20 minutes, with the possibility that some of our committee members may be asking questions as you make your presentation. After your presentation, we'll have some time for questions and answers, but probably it's going to be relatively informal, but we'd like to learn more about your company, your experiences, and what you would assume that we would be working, how we'd be working together over the next several months or maybe even years, depending upon the length of a contract that might be developed. Basically, procedurally, this investment committee will be making a recommendation to our full board, our CERS board, probably later today, and we'll let you know how the outcome of that, but that's sort of the procedure we're going to be following. So with that, in brief introduction, would you please begin with your presentation? And again, we may ask questions as you go along, if that's okay. We'd appreciate that. Okay, thank you.
Thank you so much, and we're really delighted to be here and have this opportunity. My name's Arabella Wuchek. I've been KPPA's relationship manager. I'm based in our Connecticut office, and I've been with Alborn for over 15 years. Steve?
Yeah, hi everyone. Steve Taylor. I've been with Allborn coming up on 11 years now. I'm based out of our Toronto office with my background as an auditor, but also working with Brookfield Asset Management and within the private market space going on 15 years now.
Thanks so much. And we apologize, a couple of members from our fees team were having issues with the Zoom room, but if you want to move to the next slide, please. So just in terms of the search process and trying to extract, cost efficiency, what we believe that you need as a partner is really understanding your fees better, independent recalculation of those fees, as well as putting the fees that you've paid into context versus their peers from a strategy perspective, and then also your peers. And through doing this for many years, we do often find fee errors in the tens and millions for our clients to date, and also educating you, the committee, or the board, if required as well, because these fees are complicated, especially in alternative investments, which Alborn, of course, specializes in. And these are all things that we can bring to you as a partner. So if you can move to the next slide, please. Just stepping back, Alborn, we are a specialist, independent, non-discretionary consultant focused on alternative investments. For the mandate, we understand that public market investments, so really any open-ended structure that has a fee structure upon it, we can do the validation service. But really the focus on being non-discretionary for now 32 years as of this month is really to make sure that we are always aligned with our clients. When it comes to consistent pricing, so just to focus on fee validation here specifically, we charge per line item only. So it is very clear how we're being compensated. We oftentimes find more errors and fee savings than our clients pay us. This is a very appropriate control for you guys to be adding as an investment committee. You'll see later in the presentation that most of our clients are pension plans, and all of our offerings have also remained consistent, again, not offering any fund product, OCIO, et cetera, because we are 100% employee owned. So it's all employees as well as some former employees. So this means it's not going to change. This has deserved trust. We've built trust, and this is how we've built that trust over so many years, is because it's remained in the hands of employees. If you can go to the next slide, please. So in terms of our wider services, just to try to put fees and liquidity and validation into context. So on the upper left-hand quadrant, this is really, if you think about your general consultant, Wilshire, I know came in to do some private equity education with you guys, listening to your last committee meeting. So this is something that's not in scope in our current service configuration with KPPA, but it's really that, how do you go about building a portfolio, pacing, the communication, presenting to the investment committee. But staff has had access to all of our investment due diligence reports. That's over 3,000 on the private market side. Also, access when needed to operational due diligence. And that's really, really important when it comes to fee validation, because being able to identify weak controls at an operational level often can lead to errors in your own capital account statements. Also, staff has had access to the data and the analytical tools. Think of just the performance information, deal level information that we get from managers, and the ability to put that data into context. So pretty much everything on that right-hand side of the screen, staff has had access to. The other thing from the fee standpoint is leveraging our middle office team. So they're looking at LPAs all the time, hundreds over the course of the year. So they can see when fees are changing. So for instance, when a private equity manager launches a new strategy like private credit, they're often not familiar with how to administer that. And so this is something that we see from our ODD reviews, as well as our middle office services. So all this is to say is that you're going to benefit from all of the wider expertise that we bring from all our alternatives platform. If we can move to the next slide. These are just some of the ways that we want to really bring alpha, relationship alpha to our client relationships. And it's really extension of staff in so many ways. Non-discretionary, it means you're always in control. And really here, we're going to hopefully lower your overall cost if we find errors, but additionally, really making sure that your managers are aware that they're going to have an independent third party always scrutinizing that these fees are correct. If we move to the next slide. Steve was in this really great position of developing this service for us. So I'll turn it over to Steve here.
Yeah, so as I mentioned, I started about almost 11 years ago, but we really started our hedge fund fee validation in 2014. And then when I joined, we looked at moving this service and building out the private market side. Myself and Vangelis, who is a senior member of our fees team, we actually helped build this out over a decade ago. Private markets is one of those asset classes that was very much seen as kind of a sleepy asset class. And honestly, ODD build out was the same kind of over a decade ago because everyone's going in at the same time, everyone's leaving at the same time. How hard can the accounting be? As someone who came from audit and accounting, the number of errors are kind of far too frequent in this space, and they a lot of times they go unnoticed. And sometimes it's not even just at a fund level review, which is done by the auditor. A lot of times it will be in a specific investor capital account level, so side letters, things like that. And that's the level we go to. Now, these errors that we were finding, they really came from all sorts of areas. You might have changes in terms from vintage to vintage. You have managers who are doing these calculations in Excel or are self-administered. You have changes in providers. We've seen kind of the whole gamut, but those are kind of the big points we've seen. When you layer it on kind of these errors that would come up, there's regulatory requirements, there's media scrutiny, kind of all this was just kind of a natural area that we found we could help our clients, both on the transparency side and at the end of the day, just providing you comfort that, you're paying the fees that you're supposed to be paying and not overpaying a GP. So if we can move on to slide 7. So our team, it has grown over the years as the business has grown. And so we have 40 dedicated analysts within the fee and liquidity team. Backgrounds are as you'd kind of expect, but audit, accounting, finance, operations, that were at fund admins. These are people that are familiar with the types of intricacies that come with understanding LPAs and side letters. I have read far too many LPAs in my life. But at the end of the day, that's what it takes to really understand and pick up on the nuances. But the support, of course, doesn't stop there. As you'll see later, we build all of our software and models in-house. And so this is supported by 44 developers and engineers. This really helps for everything from bespoke reporting, dealing with new models and fee structures that are coming out. It really gives us the leverage to be able to adapt to any situation. And then, as Arabella alluded to, we have our ODD, IDD, and middle office, think legal due diligence experts that we leverage. I'm primarily a member of our ODD team, but I'm speaking with the fee and liquidity team pretty much regularly on new structures, new fees that we're seeing, any unique structures, all of that. We kind of all work as a big team to tackle everything that comes across our desks. So I guess with that, we'll move to the next slide, please. And of course, jump in with any questions. I'll take a quick pause there in case anyone had anything. No.
Any questions?
All right. Oh, sorry, go ahead. Good.
Keep rolling.
Right.
Okay. Super. So in terms of just our fee clients specifically, so you have almost 60, many hundreds of billions of assets that we validated. Same thing in terms of that, think like that wider peer comparisons that we can do for you, over 7,000 funds that we've analyzed. You can see that the vast majority, almost 75% of our clients are pensions. And then on the left-hand side, just giving you a little bit more visibility into the size of total plan. So really represented by all segments, but really want to say that we're speaking with some other clients, call it in that like 25 billion or less, and I think you're sort of 30. I know it's just CERS today, but just thinking of KPPA in total. But just really want to applaud you guys for entering this search and adding this layer of control, because we do believe it's best practice. So kudos to you guys. Just going to the next slide, what we've provided here is frequency of what clients are doing. So, because one of the things that clients come to us is like, well, we think we should be checking our fees, but like, what exactly should we be doing? And so, really just showing, at the top that most clients are doing this annually, so not on an ad hoc basis. That's not to say that you guys can decide what you want to do, what's appropriate. But really doing this as an annual exercise is what we believe to be what you should strive for. And then looking at just our public pension plans, many are doing this not only annually, but also doing the quarterly reporting of fees as well. So again, this is just something to help you guys as a committee guide what the regime should look like in the future. If we go to the next slide, I'll hand it back to Steve really to talk about the process. Steve, you're on mute.
Yep. All right. And so the next couple slides, we'll be going through the process itself. Feel free to jump in with any questions. So really at the heart of this, we collect and aggregate management fees, performance fees, and expenses, and then we validate those across legal documents. And the key here is we independently calculate the expectation, and then we notify you of any potential discrepancies and help with resolving them. We discussed earlier how our fees teams works with some of the other teams, but a bit more specifically is things like issues that are identified within ODD or middle office and legal processes, these will get flagged. This can look to highlight unfavorable terms when a report is updated or completed, things like that you can really use day to day. We also include a conviction rating that outlines the confidence in our calculations. Sometimes, depending on the fee structure itself, all of the underlying detailed information isn't always available, or depending on the complexity of the structure, if it's something very much down at the asset level, there are certain aspects that might not be available. And what this does is it better helps guide that discussion around any potential discrepancies or comfort levels around fees. So moving on to the next slide. So this is the process itself. So you control how we speak to the funds. We look to act as an extension of your team. We understand relationships with GPs are very important, and so we're not looking to kind of impact that in any negative way. How the process works day to day is we'll usually ask the client, they send out authorization letters to their GPs. Then we pull in all the client-specific data, nothing for you to do there other than really authorize the GPs to speak with us. So we'll grab capital account statements, ILPA statements, anything else that we might need. And then if there's something missing, we'll send those follow-ups. We work with public pensions, and honestly, every single data point is reviewed and locked for editing. We'll touch on that data management and verification later, but I do want to stress that point. And of course, we grab all the legal agreements, so LPAs, side letters, and then we build the models based on that. Then we perform the calculations. Every fee structure can be different. For anyone who understands the private credit space, it feels like every fund is a different fee structure. And so what we look to do is always have different models built that are specific to the terms of that fund or side letter or managed account or fund to one. Then once we compare the actual amount to the recalculated amount, we will do an analysis on profit share. And of course, we'll benchmark those fees against peers. Benchmarking is important for internal analysis, board analysis, whatever it might be. And then we also leverage kind of our broader firm and data sets to assess the level of expenses as well. This can be done by strategy, by vintage. It can be kind of sliced and diced, however it needs to be done. So moving on to the next slide. And so how do you access all this amazing data? So we have something called our fee controller portal. This gives you real-time access. We've always been a firm that's about transparency, not only across the industry, but of course with our clients. Anything we can see, you can see. So this gives you that real-time access. You can get customized reports, all the benchmarking. You can slice and dice data. We can also slice and dice it for you for vintage, customized reporting that you might need. It gives you access to all the underlying calculations, data. You'll have the ability to download anything that might be necessary. It really depends how you would like to work with us, but at the end of the day, know that we're not just kind of hiding everything behind a black box. You'll always have access to anything, including the individuals themselves. So moving on to the next slide. So back to the data management point. I mean, that's really at the heart of all this. You need to be comfortable in the data that's coming through. So one thing I will stress is each data point has two people involved, an inputter and a reviewer, and then data points get locked down from editing. Fat finger errors from somebody, changing a 1.5% management fee to 1.75 or accidentally deleting something, that can lead to a ton of issues. So this is a very, very crucial part to our step. And then when through fee controller, you can also access any supporting documentation, and it's available for download. We do have some machine learning in-house. We've had a machine learning team for almost about a decade now that we use for processing standardized reporting. But even with the most straightforward templates, we always make sure we have this two-person review. Again, it's paramount to data management, and it's the only way to make sure that there's kind of comfort throughout the process. So while we will look for efficiencies, in order to keep costs lower, we'll always have that two-person data check on data management. All right, so moving on to the next slide. So on the summary side of things, you'll always have access to the team. You'll always have access to the portal and the people. You'll have access to that fee analysis. You'll have access to educational sessions. I help run boot camps all the time, or teach-ins on different topics, whether it's new fee structures we're seeing, or for example, different open-ended fee structures that we see in the private market space and some of the best practices. So this is something that I will stress. You always have access to us. This is something that we always look to do. And, that support will always be there. So I'll pass it over to Arabella.
Thanks, Steve. And just one of the other things that we see with your peer group is also helping with the annual financial report. So for the fees that you paid, that's something that we could also specifically help with, relevant to your situation. But in conclusion, it's extension of staff. You're always in control. And this is an additional control to have a robust program, especially as you continue to invest not only in the public markets, but in the private markets. And so we're here to support you, bring the specialized expertise that this requires. And we thank you for allowing us to present these prepared remarks, and happy to move to Q&A at this point. Thank you.
Well, thank you. So I understand, generally speaking, your focus has been on, in effect, the validation of performance fees as well as other fees comparatively across the market. Is that basically, and that you do not focus on other compliance issues in your reviews of an individual manager? Is that basically correct?
When you think about compliance issues, do you mean things like Wells notices, SEC reviews, things like that?
Right, other issues in a contract.
In a contract itself. So for the fee validation service, we are specifically looking at fees and expenses and benchmarking them, whether or not something's appropriate. Our ODD service is the one that will usually cover off things like, is a manager operating in line with its LPAs or governing documents outside of kind of the details of side letters and fee structures. That kind of topic of broader compliance can cover so many different aspects of it. And so it does get touched on by different services within Allborn. But I will say, when it comes to fees, expenses, that is being reviewed as part of this service. Arabella?
And I believe you could be referencing, just going back to the RFP, there were kind of like three things: validation, the benchmarking, and then sort of the contract compliance. And so that's something that we didn't bid on specifically in the RFP because we weren't exactly sure what you were trying to achieve here. But yeah, I think the operational due diligence is one service relevant. Another would be that middle office service. So think the legal document diligence, which is really going into just think the LPA for a commingled fund, providing a clear explanation of the term. There's roughly 70 terms in an LPA, basically kind of like making sense of the legalese, if you will, and then providing best practices from industry bodies such as ILPA, which is giving you kind of like the market context and then telling you what's within market, off market. And that's specifically where we would recommend that you negotiate with the managers. And so this is something that we support our clients, if you have an internal counsel, also reducing costs with external counsel. Again, transparent pricing, referred to that with this service, but that also applies to other services. So I think that that's something that, we'd be happy to explore, and just that, again, broader wanting to comply with your, making sure your managers are complying to your agreements.
So when you do a review of a manager and you find that potentially the performance fees were not accurately calculated, it would be our responsibility then to take your observation, your information, and to work with the manager to basically make those adjustments and try to ensure that we receive the appropriate performance fee structure and compliance going forward. Is that basically it? You're providing us with information about miscalculations and so forth, and then it's our responsibility and our staff's responsibility to use that information to try to correct that error. Is that essentially correct?
No, it's a really good point, and we operate in different ways on this, and we're more than happy to work with managers on resolving kind of why it occurs. Really, we leave this to a discussion between us and the client. If you would like us to handle it, we're more than happy to handle it. We know sometimes there's relationships that it'll factor into a broader discussion. We're more than happy to follow up with the manager, confirming all the issues. So I guess to break it down a bit more on a timeline perspective. So we do the recalculation. Let's say we do find an error. We'll come to you first. We won't go to the manager. We'll of course verify, ask for a bit more information, but we're not going to go to the GP and say, hey, we found this $2 million error. We would come to you first and kind of explain the situation. At that point, we would discuss how you would like to approach it. We recognize relationships are hugely important, and so we really want to do kind of whatever you would like to do. We're more than happy to go and speak to the GPs, discuss the errors, have them agree and say, yeah, no, we did mess up the rate for those 6 months, or this did happen. And we're more than happy to come to that kind of final conclusion. And then at that point, assuming it's a clear-cut error, then it usually just results in a rebate. But of course, not every scenario is perfect. Not every relationship with a GP is kind of always on the up and up. So we will always go through you first, but we're more than happy to handle those discussions.
Yeah, just to maybe emphasize, I think like there's a dial here on the extension of staff. If it's you want us to do everything and it be the lowest lift possible, the lowest burden, that's a part of the dial. If you're like, oh, we want to do that interaction with the manager ourselves, that's it too. Like just case in point with one of our other pension plan clients, we found an error for them recently. And so they said, they had remedied the error, the manager, but the client was like, we want to talk to the manager ourselves. Because again, that's part of that relationship management aspect. And so we are aware and mindful of that. And that's where the relationship is yours. That's why you have a non-discretionary advisor.
So the additional services that you could provide in such and such a case would be negotiated with you and our staff to provide additional services needed to basically deal with the issue that you found in your fee assessment.
So for the fees, everything that we put in terms of our fee quote, that's included.
It is.
Those are not additional services. I think really that, again, that kind of contract compliance thing like that, again, I'm thinking of like point 3 of the RFP. That's something that I think we can explore further. But when it comes to just the scope of the fees, like that's all included.
Could you talk a little bit about your experience of the clients that you've had, for the managers that you've reviewed? What % of them have you found compliance issues with the fee structure or anything of that nature? What's your general experience in that regard? And what would be our expectations? For example, if you're reviewing 20 or 30 of our managers, do you have any idea what % of those you might, in your experience, have found errors that need to be dealt with?
Sorry, I was just going to start just going to the RFP response because we did provide some examples there. So just starting with with private markets, again, more complicated fee structure than public markets in general, just given the mechanics of really kind of when carry kicks in. Specifically also for management fee, what are you calculating the management fee on? Is it invested? Is it right? So that's where, again, that education piece comes in. But, really going back to the ODD review, thinking of something like self-administration, even though self-administration has come down from our surveys of managers, it's still like in the high 20%. And so like, that's one thing that leads to errors. Like you don't do this going in with the expectation of finding lots of errors. It could be anywhere between 1% and 5% of a portfolio in our experience. But we see changes at the fund administrator when they're using a fund administrator, the staff. There was one instance where there was an error and then the error reappeared 2 years later because the staff changed at the administrator. So again, the issues can be so various. Also, when you're negotiating something special, think separately managed account, fund of one, especially if you decide to do more in private credit. This is something that we're seeing a lot of your peers setting up to just go through, so the ease of like re-upping with commingled funds constantly. So that's something where, you set up something that's $100-200 million. A small error can really lead to quite a significant error in your account. But Steve knows a lot of
Yeah, I mean,
examples too.
the numbers we usually say is between 1% and 5%, but it is very much dependent on portfolio. Bespoke arrangements, side letter arrangements that directly impact fee and fee structure. It could be something as simple as a side letter that's 1.5 down to 1.25. And you just have someone who doesn't process it. Usually, when you have non-standard arrangements, that number trends higher towards that 5%. And if you're just primarily, headline rate, headline terms, headline structure, so third-party administered manager, decent auditor, you're likely not going to see as many. I mean, I say that, but I still remember years ago picking up a set of financial statements and just telling the manager, "You miscalculated carry." And they say, "What do you mean?" And sure enough, we looked. I was like, "Yeah, your rate's way too high." And that was financials. Big Four auditor, well-known administrator. So it does still happen, but again, the biggest factor is going to be the complexity of your portfolio and fee structures and the bespoke arrangements of it, with those other factors like self-administration, use of Excel, changing of terms, turnover of staff being kind of, I would say, the secondary pieces that very much move the needle as well.
And if we do find an error, we just want to emphasize that you will receive 100% of that amount. We're aware of other providers where they're taking some percentage of whatever they find. So that goes back to the transparent pricing. It's per line item.
Yeah, we'd never charge on that because then our incentives would be to not find the error for a few more quarters and increase the size of the error. I mean, it's something where, we talk about how we've recouped upwards of 30 million, but really what that did is it heads off a lot of errors kind of before they actually start to snowball even further. And that's really what anyone wants at the end of the day. These errors by GPs are very unlikely to be malicious, and in our experience are generally not malicious. They are, just errors at the end of the day. They're mistakes that people have made. And it's not usually in a scenario where a manager was looking to artificially inflate factors. Now, we have had those issues, particularly invested capital is one area that's been a heavy focus within the US and by the SEC, and something we've been calling out for years. But for the most part, these are generally genuine errors that people are just looking to make sure get fixed and don't happen again. Bill?
Bill?
Yes, thank you. Yes, I'm unmuted. I have a habit of not doing that.
I feel that, Bill.
Yeah, I'm trying to understand the size of the bread box here. Have you all, you say per line, and then I saw a recap saying per fund. I don't know how much money we're talking about spending here. So have you all priced this, if you did 100% review, what the fees would be?
So it just depends on the scope. Do you want, again, the entire portfolio? So it's the same per line item per fund. It's essentially the same.
So if we had, I think we had 20 managers and 125, that'd be 145 times 2,000. We're talking about $290,000. Am I doing the math? Am I estimating right?
Yes, so I'd say that's a good estimate. That's also assuming that you want to select the service level since inception, which is really appropriate for more end of life funds in the private market. So I think really getting to identify, which funds, which asset class, our recommendation then, the $800 per fund may be more appropriate. So that's really just, looking at more the portfolio and nailing down the scope. So I'd say at the high end, Bill, that's what you're looking at, but I wouldn't expect, like the annual service would be 116K on 125 line items. And again, that's not even counting for the fact if we find errors, which again, not that to say that we will find that, but often the service pays for itself.
Okay, and then I wanted to clarify what is included in that fee and what isn't. So you were talking about the middle office and the ODD review. Is that additional or is that included in this fee?
So based on our existing relationship with KPPA, it's mostly centered around our investment due diligence. And then there are a couple handfuls of operational due diligence reports that you have access to. And I believe staff has just used that when, when you've needed it, but you do have the ability to add more if needed. The legal document diligence, which sits within middle office, is not currently something that you guys have utilized. So that would be additional. But again, we can often structure that as just when you need it. And it's really for negotiations, I think is most appropriate. It's on the way in versus backward looking. Like the fee validation, this is backward looking. Making sure you're getting the best, almost like best execution, to use like sort of a public market concept. That is what we would recommend the legal document diligence and potential, deal support if you guys are using side letter with your managers to really achieve the best possible fees on the way in.
Okay, thank you.
You're most welcome.
Okay. Bill, thanks for coming up with the number. Check my math. I've heard a lot about validation, and validation to me is certainly the first step. You got to know where you've been before you know where you're going. But our discussions previous to this have always been around two components: the validation, but also how to generate cost savings. I'm hearing you touch on those areas a little bit. It sounds like from the conversation, it's almost we're there to help you, not that we are going to do it. I want to hear a little bit more about what you all have generated in the way of cost savings, both from the standpoint of what you uncover through your validation process, as well as going forward with regard to areas that are available for renegotiation or some other type of operational cost savings.
Absolutely. So again, with the fee validation, again, backwards looking, okay, if you've made an error, we're going to find it. You're going to get that money back. On the way in, so for new investments, that is where we can make sure that you're getting the best possible terms. What are the terms that should be improved? If we actually go back to slide 5, Sherry, if that's possible, this is a really good thinking about our entire platform. When you're thinking about just big picture, how to get more efficient. So if we want to stick on the right-hand side, so one thing, we get aggregate consultant discounts with managers. So for example, we have a large, wider client base, over 300 clients. Manager will say, hey, we're going to lower the management fee if you're able to aggregate client investments. So instead of paying, say, 1.5 management fee, you pay 1.25. That's one way to lower costs.
Explain that again. It sounds, and I may just not misunderstood. It sounded to me like you were basically saying, because of our relationship with these particular managers, if we are, I don't know, aggregating half a dozen or a dozen of our clients to be investing, we'll get you a lower deal. Is that what I hear?
That is exactly correct, sir.
That seems to me like a little bit of a conflict of interest to me.
Great. You're right. And for many consultants, that is a conflict because they have the discretionary book of business that we do not have. And what they're using is their discretionary capital. They're saying, hey, here's an advisory client. We're going to bring in $100 million of advisory capital. We want to get a lower management fee if we bring that in on our discretionary capital. That's been going on since the dawn of time in the consulting business. And so we avoid that conflict because we don't have the discretionary capital. Additionally, the ACDs, the aggregate consultant discounts, are not a discussion that the due diligence teams, investment and operational, have with the manager. It's done by the middle office team so that it's an independent process for Alborn. So it doesn't influence our opinion when it comes to our qualitative ratings for due diligence. I can go on. I want to be cognizant of time. We can talk about this stuff all day. We love it. But George, I would refer you to this particular slide on how we can make you guys lean and mean, like super efficient, always keeping you in control, and just across our broader platform, these are the ways that we believe that you can improve performance with us, lower costs,
Well,
always remain in control.
so, I heard a couple of different numbers thrown out. Somewhere between, what was it, 3 and 5% or something like that of managers you tend to find an issue with. Is that
1 to 5% in
1 to 5?
general?
Okay.
Yeah.
All right. So, if we're looking at 145 managers, that puts us somewhere in the neighborhood of, 2 to 8 for rounding purposes. Based on that and based on your experience, what kind of rebate / future cost savings can we expect?
That's something that is just I don't want to even put a number on it because without knowing each term, each portfolio, each structure, you just can't.
Well, I understand that, but you know,
Yeah.
by your own admission, you've done what,
Yeah.
7,500 of these investments or whatever.
Yeah.
You gotta have a range.
So I mean,
Low
you can go
ball is if
30
you want.
million.
It's 30 million in total that we found to
Yeah.
quantify. So of the 7,500 funds, we found
Okay.
$30 million of errors to
That
date.
that's helpful. Thank you very much.
Yeah.
That
So that'd be
that's helpful.
4,000 per fund, assuming every single fund had an error.
Yeah, gotcha.
Yeah.
I think we're arriving at we've been running about 40 minutes, maybe 1 or 2 more questions if anyone has. That would be good. Any committee members with other questions, comments, or other comments that you would like to make about why we might want to select your firm?
If there's no more questions from the room, look, we again just believe in extension of staff. You've got a good staff here, but we also recognize your role in the governance process as a committee. And so we're here for the staff. We're here for you as a committee. In the back of the slide deck as well, we put some of the slides that we use in similar presentations to help you guys understand what are these terms. I mean, this stuff is complicated. Most of our clients try to do this in a spreadsheet and they just pull their hair out and they say, I just can't do this. So that's why they hire us. We know the managers, we see the terms from the other parts of our business. We're independent. You can trust us. We're not going to change. That's why you should hire us for this service, we believe.
Well, thank you for joining us this morning. We appreciate your presentation. and your responses to the questions that our committee members have presented. So thank you very much, and we'll be deliberating, and basically the process we go through is the investment committee will review the presentations, information that's been provided, and we'll be making a recommendation to the full CERS board, and we'll be doing that in the near future. So with that, I think you're excused. Thanks again, and have a great day.
Thank you. Great meeting
Thank you
y'all.
so much.
Take care.
Right, bye now.
Bye-bye.
I can verify, Dr. Hackbart, that they've left the meeting.
Okay, thank you, Sherry. Getting back to the agenda, I think after we had anticipated, as you know, 3 presentations. We now have had 2, and I think our challenge is to decide whether we would like to make a recommendation to the full CERS board about whether we go forward with this process, and if we'd like to present the full board with a recommendation as to which firm we would recommend CERS develop a contract with, given the RFP that we were presented. So I guess we could start when possibly any conversation. We could start with a motion. Either one would be fine.
U.S. Border Patrol caught him that same year.
Dr. Hackbert,
Yes.
I think the way you phrase that's probably appropriate. I think the first question, at hand is this something that we see value in pursuing?
Right.
And whether whether it's Auburn or whether it's XTP, the 2 things I came out of those presentations with was either we've got a problem with somewhere between 1 and 5% of our managers, and XTP's thought is they can generate somewhere on the low end of 3 basis points of savings, which tells me they see a problem somewhere. So I don't think there's any question in my mind that we, if you want to start by having a motion that we pursue the process itself, I would certainly make that motion in order to open up discussions on the 2.
I'll second that motion.
Thank you. We have a motion and a second to proceed with developing a recommendation to the full board. All in favor, please indicate by saying aye.
Aye.
Opposed? Motion carries. So now we're at the process of deciding which of the firms we would like to recommend to the full board. Would someone
I,
like?
for one, am all about a performance-based fee schedule versus a flat fee schedule. I know they said that they had thought that somebody that was based that way may wait a few extra quarters to get some money. Well, either way, regardless of how it works out, it's still going to benefit CERS, in my opinion. That's my 2 cents.
I agree with Mr. McGraw in that we have a risk-free avenue where we can only make money.
I don't have a problem. I don't have a problem with either fee schedules theoretically. I've always operated on a performance basis myself, so I certainly understand the benefit to that. The thing that jumps out at me more than anything else between the 2 is A1, this is all they do. I'm a little bit concerned with whether it's a true conflict of interest or a perceived conflict of interest between both being in the money manager recommendation business and the auditing business. But honestly, I want to validate our fees. There's no doubt about that. I want to generate savings. That's my personal, reason for going down this path. And based on the numbers both of them gave us, I'd rather have a $500 million than all of $30 million. And that's what one says they've saved versus what the other one says they've saved. So I'll leave that, at that point.
If I understood their materials and their presentation, it seems that XTP has a broader mission in their reviews than just fees. Is that everyone's understanding?
I think, well, the only way they're going to make any money is if they generate a savings.
Right.
The way I understood it.
Well, in comparing them, I say Allborn is very focused on fees only with a known cost. So we know how much how much the check has to be written for to have a review. We have unknown savings, but we have shared data. I don't know the value of that. With XTP, they're kind of a nebulous, we're going to look at everything. It's going to be, we'll just look at everything. And we have an unknown cost. We have unknown savings. But it's a full review, even though it's kind of nebulous. They kind of juked and jived as to what they were going to do. From my perspective, it's going to be all in renegotiated agreements. And so I have no idea how successful that is in the industry. So one is a known, it's limited. One is broader based, and it's unknown. So
Understand, Bill, in effect, the cost of XTP is zero unless there's findings that we pursue. Is that everyone's understanding?
Yeah, that's what I understood. And they said they're going to go back and look for billing and invoice errors. It's not just going to be on contract negotiations, correct?
And because of their shared fee, they would be benefiting by doing further and more in-depth assessments and evaluations, because that's the only way they get reimbursed.
It just seems like they would work harder to me, because the harder they work, the more money they're going to make, which in turn is going to save the pension system money.
I would agree with that. Just simply, I mean, if we don't do one or the other, then we're not going to save anything, and we're costing our system and costing our beneficiaries. Just based on the evidence they presented, as I said, one has generated $30 million in savings and reviewing 7,500 managers, and the other one has generated $1 billion worth of savings and reviewing 1,000 managers. I think it's because of the focus that's where and how they make money. I don't think you can chalk it up to anything else.
Other comments, observations?
I have no argument that their single focus is that. I have to admit I bring forward a prejudice about the shared fees. In my former life, we did this on utilities, and we didn't get any money to split with somebody. We got a calculation, write me a check. And it was pretty controversial as to true savings. We changed light bulbs, so for the next 10 years, we have to write you a check on the changed light bulbs because they save less, use less energy. So those are the type of experiences I've had. And that's why I was asking, do we pay forward or do we pay after the savings are in the bank? And so it's very important to me that these savings are shared after the money is put into the bank.
I agree
Then
with
we
that.
are going to write. Then we are going to write a check. We still write checks,
Yeah, I 100% agree with that.
but I want those savings to be captured and tangible before paid.
Yeah, I 100% agree with that.
I think that could occur for clawbacks if they occurred, but going forward, Bill, I understand what you're saying. They're prospective savings versus real, and at some point in time, I guess there would be a calculation whether those perceived future savings are actually realized, but
I think if I understood her answer to that question right, somebody correct me if I'm wrong, is on the projected future savings as each manager bills on a quarterly basis, they would sit there and say, all right, this is what the bill would have been, this is what it actually was, therefore you have this savings amount, you owe us half. Is that not how they answered that question?
Right, and that's not money in. We're writing a check for that.
Well, it's money
calculated savings.
Yeah, it's calculated savings, but if we were going to send a manager, let's just say $1 million, and all of a sudden no, we're only sending them $700,000, we save 300, and we send them 150, we still have 150 in our, it only cost us 850 instead of $1 million.
I believe they also indicated that they would bring cases to us, and we would decide whether to go forward on that particular case or that particular situation.
Yeah, and
that was important.
I was a little bit surprised at that answer. If they bring us a bunch of cases and we decline to pursue any of them, they're not going to make a whole lot of money.
And that was not the case in my experience. So that was a very important answer that she gave.
Yep. I would be in favor of recommending XTP, but I would want to make darn sure all those questions that you're referring to, Bill, are tied up in the contract before we ever signed it.
I think it's important, just from my past experience.
Yeah. Are you, by chance, referring to a energy efficiency contract?
Yes.
Yeah, I did one of those with Train, and I had a good experience. We can talk about that sometime, but I had a really good experience. I graphed my utility expenses for the city over my 16 years, and that was one of the few things that actually went down.
Good.
So, anyway.
Any other pre-motion comments or suggestions, reactions to either presentation?
I'll make a motion that we do XTP.
Is there
I'll second
the motion? Motion's been made to go with XTP. Is there a second?
I'll second the motion.
Okay, thank you. Motion's been made and seconded to go with XTP. Is there further discussion? Recall now we're making a recommendation to the full CERS board. The decision will be made there, and there is time for additional information to be collected and received.
So I would just ask that those issues on the contract are important before the contract is executed, as Lyle mentioned.
I not only that, I don't have a problem asking them to put the answers to those questions in writing back to us prior to the board meeting.
Good plan.
Are we ready to vote? All in favor of recommending to the full board that we develop a contract with XTP, please signify by saying aye.
Aye.
Opposed? Motion carries. I believe that's our meeting today. It was a really, I think, very informative meeting session. I like the informal discussion we had back and forth, and I think it filled a lot of crevices in our understanding of their approach to the issues of the expanse.
I did enjoy both presentations. I learned some stuff.
Good. Okay. All right, with that, the meeting is concluded. You all have a great day, and
Thank you.
stays warm the rest of March.
All right.
Yeah.
Okay. Right.
Thank you, guys.
Thank y'all.
Thanks. Bye.